Welcome to my channel. I'm going to show you step by step how to value a stock so we can determine if it's a buy or a sell. At the end of the video, we're going to look at the financial ratios. Leave a comment and I'll be sure to answer. The company we're going to look at is Hardwoods Distribution. This is a Canadian company and they wholesale hardwood lumber, plywood, and similar products. The company operates distribution centers throughout North America. And this stock is traded on the Toronto Stock Exchange. Let's get started with the model. This company has a market cap of $450 million. So they're a small cap company. Let's see what they're trading at. $21.29, so that's one share of stock. And the way you value a company is you estimate the future free cash flows and then you discount that number back to today's value. That's what we're doing in this video. Now I'm pulling the actual free cash flows. Free cash flow is cash flow from operations minus capital expenditures. CapEx is what you invest in property, plant, and equipment. Now I'm pulling their net income, which is a profit and loss on the income statement, and their revenue, which are the sales on the income statement. And their sales have been increasing nicely each year, which is good. And their net income and free cash flow looks pretty consistent. They had one negative free cash flow year, but everything else looks good. Let's look at a capital structure. They pay $9 million of interest on their debt. Let's see how much debt they have. We'll go to the liability section of the balance sheet. And they only have current debt of $121 million. That's debt due within 12 months. And they pay 7.8% interest on their debt. Interest payments are tax deductible, so let's get their effective tax rate. Income before tax is $39 million, income tax of $9 million. So the effective tax rate is 24%, so the cost of debt is 5.9%. Let's get the beta so we can get the cost of equity. The beta is how volatile the stock is relative to the market. They have a pretty high beta, 1.82, so the stock moves a little less than 2 times the market. We also need the current assets to calculate the current ratio later, and that's on the balance sheet, and that's $348 million. And that's $15 million of cash, $112 million of receivables, and $207 million of inventory. Let's get their current liabilities, that's $202 million. And that's $121 million of current debt, $53 million of accounts payable. That's how much money the company owes other companies over the next 12 months. And let's get the stockholders' equity. That's the value of the company according to the balance sheet, $283 million. $113 million of common stock, $48 million of retained earnings, and $16 million of accumulated other comprehensive income. Let's go back to the income statement, get their operating income. That's how much money the company makes on its regular operational business prior to paying interest and taxes. Let's look at a capital structure. 30% debt, cost of debt is 5.9%. 70% equity, cost of equity 16.3%. And the WACC is 13.2%. That's a blend of the cost of debt and cost of equity, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows, that's here in blue. We also estimated a terminal value, which is all cash flows past year 4. We discounted those numbers back to today using the weighted average cost of capital, that's here in green. And we get a value of the company at $235 million. We divide that by 21 million shares. We get a calculated stock price of $11. It's trading at $21. So it's trading at a 91% premium, so it's a sell according to the model. Let's see what Simply Wall Street has. They're at $13.55 a share, so they're also saying the stock is overvalued. Let's see where it's been trading at. So it looks like it was trading around $20 a couple of years ago, then dropped quite a bit to below $10, but it's been ramping up since coronavirus. It's at its all-time high. This seems like the type of stock that would do well during coronavirus, even if their financials don't indicate that. Let's look at the financial ratios. They have a decent PE, a really good price to sales, and a really good price to book. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. I like to see below 15. They're at 15.2, so that means investors are willing to pay $15 for $1 of earnings. Price of sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. I like to see below 2.5, they're at 0.4. So investors are paying 40 cents for $1 of revenue. It's a really good ratio. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. I like to see below 3.5, they're at 1.6. So investors are paying $1.60 for $1 book value. A good current ratio, a good interest coverage ratio, and a weak ROE. Current ratio is current assets over current liabilities, and they're at 1.7. I like to see between 1.2 and 2, so that's good. They can cover their current debts and payables. ROE is net income over equity. I like to see above 20%. They're at 10%, so they don't provide the best value to their equity holders. Interest coverage ratio is EBIT over interest expense. I like to see above 2. They're at 5.1, so they can easily cover their interest payments. And the best way to look at ratios is to compare them to similar companies. I did a video on Fastenal, who is also in the same industry as Hardwoods. And Hardwoods has a better PE, price to sales, and price to book. But Fastenal is better in current ratio, ROE, debt. Fastenal is much bigger a company, $26 billion in market cap. Hardwoods market cap is under $1 billion. Let me know what you think. Leave a comment. I'll be sure to answer. Thanks for watching.